Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry market analysis and trade ideas webinar, the first analysis webinar of 2025. It is currently roughly 6:45 p.m. Eastern, Monday, January 6th. Through this webinar, we're going to go in the order of topics and events, starting out with a quick overview of market conditions and market timing. Then looking at our economic calendar, a breakdown of market sentiment, and then, of course, going through the individual charts of the pairs we analyze and trade day in and day out to break down the fundamentals and technicals and line up some high probability trade setups for both the day traders and the swing traders. Let's jump right into it, shall we? Now, first things first, market timing and market conditions. We have noticed that to start out the new business month of January and to start out the new year of 2025, volume and volatility has been relatively subdued. Market conditions are not the most ideal for holding day trades for consecutive days or swing trading just yet. There is the opportunity for quick jabs at the market and for the scalping style traders through the session volume, but even that has been quite choppy when observing price action across different asset classes. This is, of course, as we have markets more on edge and sitting on the sidelines regarding liquidity, as a lot of the major fundamental events have passed, such as the last FOMC of 2024, the the selection of Trump to become president, and markets are awaiting some of the key events approaching in the near term of January, such as some of the important US labor market data at the end of this week, and the actual inauguration of Trump, which is just around the corner early January. So we do have to be adaptive to market conditions, where when looking at various asset classes, we didn't get much significant movement. For example, looking at gold, we can see overall we're subdued in more of a higher time frame consolidation. But even zooming in and looking at some of the movement through the previous sessions, we're just getting very aggressive whipsaw plays. Downside and upside movement that's not being sustained and canceling each other out, creating quite sporadic price action and lower quality trading conditions. You can also see this even on GJ with some intraday whipsaw moves, even on dollar pairs with the example of GU primarily ranging around key level here as well, and not seeing significant movement on US equities either. So this is something we have to remain adaptive to. It looks like we're going to be getting some more juice, some more fuel for market liquidity in the second half of the week, Wednesday, Thursday, and Friday, with more important economic events in play. Today, we did have some economic data through the US New York session, but nothing that was substantial. It was S&P non-manufacturing reporting, composite and services PMI. Now, S&P data isn't as important or as hard hitting in terms of market impact compared to ISM reporting. ISM is going to be tomorrow on the Tuesday, January 7th, which will go through the economic events calendar right now. Next week, we'll be doing our normal routine weekly prep webinar on the Sunday. We'll send out the entire weekly flow and, of course, look at the calendar for the entire week. But every day, we look at the economic events, anyways. So, through the Asian session today, looking pretty quiet, no major economic events or anything in focus. Then, actually entering the Tuesday period, January 7th, we do have some important economic data for the UK, parts of the Eurozone, and for the US. Starting out at pre-London hours, 2 a.m. Eastern, we have some UK Halifax house pricing data, which is primarily going to be a signal of real estate inflation within the United Kingdom. I'm mainly looking at the month over month data here. Now, market expectations are showing the forecast dropping lower than previous figure, going from a prior figure of 1.3% down to around 0.8. This makes sense as Bank of England has primarily maintained tighter financial conditions. They've maintained interest rates in a restrictive territory position to continue to pursue their goal of bringing inflation down to 2%, but not just bringing it down to 2%, maintaining it at 2%. This is obviously going to weigh negatively on the real estate market within the United Kingdom. So a drop in UK house prices is expected. What would hold more market weight and can bring some GBP bears that we would need to adapt to on GJ and, of course, assess on GU is if we come out lower than forecast. I think we're going to be right around forecast here, maybe even slightly higher, around 0.8 to 0.9. Let's also check out what the market AI is telling us about this data. So I'm just going to click the brain here next to this. I always like to compare it. I always like to compare it with my analysis, do my own prediction first, then see what the AI is talking about. So I was personally thinking it's going to be around 0.8, even slightly higher, 0.9. The AI prediction is an estimated 1%. So that's pretty much in line with my prediction, where we're still going to see a decline from prior, but overall be elevated above forecast. I think that's quite dependable, but obviously we can be wrong and we have to see the data as it comes out. If the prediction is correct and we're still above forecast, this should still keep some demand in the British pound, which in my opinion can follow suit on our analysis of GU, of seeing some short-term upside on GU before we retest better sell zones, and overall still holding more bullish structure on GJ, where overall we've been in more of a bullish bias due to the macro interest rate differential still holding the most weight there. After that, the next set of really important data is looking at some European CPI for Italy, but really the main stuff is for the UK there. Then we're going to be going into some of the key data through the North American trading session. Due to the timing of the key data through the North American trading session being at 10 a.m. Eastern, we're going to be starting our New York session Zoom roughly around 9 to 9:30 a.m. Eastern. So we can cover the New York Stock Exchange open and see the surge of volatility through that period, as well as the data release here. The main focus point is ISM services PMI here. We also have some JOLTS job opening data. We did see on the S&P reporting today that services PMI was slightly cooling, but that doesn't guarantee ISM will follow the same way. I still think that ISM services PMI is going to remain in expansionary territory, probably just remain the same as previous. That's my prediction. My prediction is either around 52 flat or remaining the same around 52.1. I don't expect to see an increase in it as the forecast. I think we're going to be slightly below the forecast, similar to prior, as Feds have still maintained a slow and steady approach to rate cuts. They're still very goal oriented and focused on bringing inflation down. And obviously, the tighter financial conditions does start to weigh negatively on the services sector, right? But let's check out what the market AI also thinks. So Market AI also thinks that we're gonna see an increase from previous, but below the forecast, around 52.8. My prediction is pretty much around 52.1 to 52.2. So pretty similar. Also, if you guys want, I can copy and paste and send this breakdown to the trade room. But the event details is just highlighting how PMI data works, which is what we talk about in the educational webinars. Obviously, the event's significance if we come above or below the 50 grade point. The main thing is looking at here of talking about how the services sector PMI gives us more information about inflation within the services sector and Fed positioning, something we teach quite aggressively in Capital Hungry. If the services PMI is coming out around 52.2 to 52.8, still above previous but lower than forecast, it may have a muted market impact. But I don't think it's going to lead to any substantial change as we're still quite above expansionary territory ranges, right? We're still well above the 50 grade point, and there's still some upside pressure to inflation. What we have to look out for is if we come out higher than forecast as a surprise, which can lead to some dollar bulls and gold bears. Coming out slightly below forecast will probably lead to some short-term gold bulls before sellers come into play and short-term dollar bears before bulls come into play. Pretty much the setups we were talking about from the New York Zoom session today on the Monday. Also at 10 a.m. Eastern, besides the higher impact ISM Services PMI, which is going to be giving us some inflation information, we also have a jobs report that's going to give us some clues and signals towards the NFP and unemployment rate at the end of the week. Now, overall, the labor market in the US has been showing some signs of cooling, showing some signs of weakening amidst the tighter financial conditions, which is very normal and routine. Jolt's job openings are expected to show a slight decline on the forecast. My prediction is we're going to come out even slightly lower than forecast, maybe around 7.6, 7.65. Let's see what AI is thinking. AI is thinking around 7.68. So, you know what I mean? Jeeves pretty much got the brain of AI, if you guys want to note that down with these predictions so far. I'm just fucking around. But, anyways, with the Jolt's job opening data, if it comes out lower than forecast, showing further signs of cooling in the labor market, this is where we need to be a little bit careful. This is where we can get some whipsaw moves in conflicting data. What do I mean by that? Well, if ISM services PMI is still lower than forecast, that would be if ISM services PMI is still higher than forecast with upside pressure on inflation, that would be, of course, leading to markets pricing in rates being up higher for longer. And that would be more bullish for the dollar and bearish for gold, right? But if Jolt's job opening is lower, showing signs of cooling in the labor market, that would increase rate cut expectations, which is of course bullish for gold and bearish for the dollar. This is where we can get a little bit of data confliction. What would be ideal is either having a straight, clean pushback on rate cut expectations or one sided data feeding into more rate cut hopes. So, what would that be? Well, for one sided data, that would push back rate cut expectations and lead to dollar bulls and gold bears. We would need ISM services PMI coming out above forecast and Jolt's job openings still being healthy. Still a healthy amount of Jolt's job openings, right? Showing that the labor market is still resilient. This would show that the feds can take a continued slow and steady approach to rate cuts and obviously lead to more dollar bulls and gold bears, right? Push back on rate cut expectations. If ISM services PMI is lower than forecast, lower than prior, with weakness in the job market and lower job openings, this would feed into rate cut bets. With lower inflation and weaker jobs data, this increases markets pricing in a faster approach of Fed rate cut bets. That would be one-sided, bearish for the dollar and bullish for gold. So it might get a little bit messy tomorrow around 10 a.m. Eastern. Hopefully, we get some one-sided data, but I always like to share my expectations and breakdowns regarding that, right? But besides that, no other major economic events in play. Tomorrow, the main data points I'm focusing on are the real estate prices information for the UK at pre-London hours for GBP, and then mainly looking at ISM services PMI and JOLTS job openings for the US at 10 a.m. Eastern for US dollar, gold, and US equities. Anybody have any questions about the economic calendar and pre-planned economic events? In terms of market headlines, reactive headlines, we don't really have any high impacting reactive events. We have noticed with the Canadian government and Canadian economy, Justin Trudeau has resigned from being the leader of the Liberal Party. He has not fully left his position of Canadian Prime Minister yet. A lot of people are getting confused about that. He will still be performing his duties of being the Canadian Prime Minister until the end of the first quarter, until the end of March. He's just resigning as the leader of the Liberal Canadian political party. So I'm not expecting too much market volume and volatility from that. What we also have to look at reactively is any headlines regarding tensions with Mr. Donald J. Trump as we get closer and closer to the presidential inauguration. Other than that, still keep your heads on a swivel if you have the market terminal looking at these headlines, or of course from the Capital Hungry newsroom, right? Now, let's break down the charts and market sentiment. Starting out here with US dollar. Overall, US dollar is still very bullish in my books. When I'm looking at US dollar positioning, I'm not just looking at the US economy and Federal Reserve policy by itself in singularity. I'm looking at the US economy and Federal Reserve central bank policy in comparison to other global major countries around the world. When you're looking at the size of the US economy, the business activity, and the resilience of the US economy, it's still far stronger than Europe. It's still much stronger than Japan. It's still much stronger than countries that are facing economic turmoil right now, like China. It's still much stronger than countries that are facing economic turmoil right now, like Canada. And when you're looking at the central bank policy positioning, yes, through the last FOMC, the Federal Reserve is adjusting their rate path in 2025 to take a slower and steadier approach, which you can see the global interest rates down here. The Fed is the very top line up here, right? And you can see that they're all slightly curving down to expect more rate cuts over the coming years. Bank of Japan, obviously, on a rate hike cycle, slow and steady approach. But the Fed is still taking a much slower and steadier approach to rate cuts versus the majority of other global countries, especially compared to Bank of Japan with the monstrous interest rate differential active, especially compared to ECB and Bank of Canada, where their economies are a lot weaker. The two countries that are more neck and neck regarding policy positioning is really Bank of England and the Feds. But the Feds are still taking a slightly slower approach to rate cuts, even compared to the Bank of England. The resilience of the US economy compared to these other global weaker economies, the interest rate differentials and slower and steadier approach to rate cuts by the Fed, Trump coming into play, which Trump is very pro America, whether with his domestic policies to increase American business and economic activity, or with his international tariff threats. This is all driving more demand into the world reserve currency, which is the US dollar, right? So even though early into this business month, we're getting some bearish moves on the dollar, it's still respecting bullish market structure. We still had a very strong break of a resistance that we haven't broken above since we were in the dollar domination phase of 2022, right? And we're still maintaining very strong bullish market structure with these continuous higher highs being printed in just short-term secondary phases of market structure, right? So at the end of the day, we still had a new intraday high printed here, which I'm just on the 4-hour time frame for the dollar index. And that pullback, even with some of the declining US economic data today, did not lead to any shift of structure. Two major buyer zones I'm looking at on dollar index are one around 107.5 and two around 105.5. If we do have short-term weaker data, I'm just expecting we would see an even deeper extended pullback phase, but still see macro buyers coming into play due to the fundamental reasons I was just explaining. But even tomorrow, if we're just creating double bottoms around 107.5 and not breaking lower, we're still maintaining very strong bullish fundamental supporting factors for the dollar, as well as beautiful bullish technical structure on the dollar here too, right? Majority of these times, due to the Trump trade, due to the Feds taking a slower and steadier approach to rate cuts, due to the resilience of the US economy, majority of these pullback phases from intraday highs end up finding a support and getting faded out with on the minimum at least retesting that same high and more than likely even continuing higher, extending trend, extending buyers in control, right? So I'm still on a bullish bias on the dollar. I still want to see if we could just get a retest of 107.5s or simply be fading out this bearish move back above the 108.5s and continuing buyers in control on the dollar. When looking at the Japanese yen individually, which we primarily just look for more information when trading GBP JPY, I'm still quite bearish on the Japanese yen. Overall, the Japan economy is suffering. They have an aging population. They have very low immigration. They haven't seen much expansion in several sectors across their economy. They need the continued support of stimulus to pretty much even just keep the economy afloat, which sounds scary, but it's very true to be honest, right? There's also a lot of risks that are associated if the Bank of Japan is too aggressive with their rate hike cycle, or even too aggressive with signaling the market of tightening financial conditions or raising rates. There's a lot of risk alongside the unwinding of the Japanese yen short carry trade that has been active for almost 8 to 10 years. So, with the weakness in the Japan economy, the Bank of Japan's inflation goals and growth goals yet to be met, the slow and steady approach they need to take to tightening financial conditions, the very low interest rates on a global stage compared to other major countries. There's still major bearish fundamental factors for the Japanese yen. To easily, even if we retest this same resistance point and sell side zone, or just start clearing below these lows, give or take a pullback phase, to easily on the minimum be driving down to these previous higher time frame lows from roughly July and August of 2024. We have not seen any reactive events to spark Japanese yen safe haven demand either. Geopolitical tensions have been put on the back burner, with even seeing some more talks about ceasefire. We haven't really seen any other fear, uncertainty, or doubt inducing events that can spark short term Japanese yen strength. The one risk to Japanese yen bears is that if we see excessive bearish volatility, it can trigger the Japanese Ministry of Finance pricks doing a currency intervention, which, unlike a China or India currency intervention, Japan follows a principle of doing what they call quote unquote stealth interventions. They don't announce it, and they pretty much just end up intervening their currency market if the Japanese yen is falling too much too fast, which can be very annoying for us as day traders or scalpers trading Japanese yen pairs, right? But the downside volatility on the Japanese yen has been relatively subdued, nothing out of the ordinary. So we're still very bearish on the yen. When looking at our equity markets, we have been noticing some exhaustion across the board, with some rate cut bets being priced in and expectations of further rate cuts being pushed down the line. Growth forecasts for North America and Europe starting to push more towards the downside. Positioning and rebalance of flows for the start of the new business year of 2025. Profit taking on some of these stock markets across regions and different parts of the world from all-time highs as well. It does look like we're in a short-term period where we're going to see a bit more dollar domination and a bit more bears on asset classes such as US30 and SPX or gold, or at least a bit more consolidations, accumulation and consolidation phases before we see the next leg up. VIX isn't seeing any significant upside, but it's also been generally muted around these prices. More than likely can just be ranging at these higher time frame lows, in my opinion. Now, going into the individual pair analysis or asset class analysis, starting out with gold here. Overall, gold, in my opinion, is in a secondary phase of market structure, which so far is looking like a consolidation phase from around the general highs of 2750 to general lows of 2550. We have been playing gold bulls through the majority of 2023 and 2024. This is because we had so many compounding bullish fundamental catalysts for gold. We had healthy central bank purchasing demand, rising geopolitical tensions in the Middle East at that time, markets vigorously and aggressively pricing in rate cut bets, healthy global liquidity flows, and of course, this translated to very strong bullish structure on gold. But the markets move in waves. And every time you have a very strong impulsive wave, you can always get some type of secondary phase of market structure, whether it is a larger, higher time frame retracement or a consolidation phase. So far, gold looks like it's entering a consolidation phase at these all-time highs. We're looking at pricing where we can see buyers showing a lot more exhaustion from these general all-time highs. The same time, a lot of the bullish supporting factors for gold are starting to get priced in, pushed back, or faded out. We don't have any further escalations of geopolitical tensions, and the risk premiums associated with the Middle Eastern escalations have all been priced in. Markets adjusted to that a while ago now, right? A lot of the rate cut expectations have been priced in, and we've even seen with the last FOMC, which is of course December 2024, that the Federal Reserve has adjusted their rate dot path, the majority of FOMC members, to see a slower and steadier approach to rate cuts through 2025 than previously expected, which we highlighted through the Summary of Economic Projections review. That's also a bearish fundamental factor for gold. Lack of geopolitical tensions, profit taking from all time highs, repositioning of flows into the new business year, dollar showing some more strength as well, in my opinion, can see gold at least consolidating at these all time highs, with us primarily looking to play some of the more bearish moves for day trades and swings on the minimum to at least be going down into these price points of interest roughly around the 2540s to 2550s, which is almost an 800 to 1,000 pip range from current prices give or take if we have a slight pullback to 2660s, right? So even though we've been extremely bullish on gold and we called fantastic buys through the majority of last year, it doesn't mean we can just keep blindly buying unless you're investing in gold and dollar cost averaging in. As a day trader and swing trader, you want to adjust to the market waves accordingly. And in my opinion, I think we could see gold retest into the low 2530s, 2550s before we even think about better higher time frame buys again. And we may even see larger bearish corrections take place. But on the minimum, I want to take it step by step. When I'm looking at gold here and zooming in further, outside of the clear resistances being formed, for example, here around deeper 2700s, we can also see the formation of bearish structure, which is just going to be subjectively drawn here with a trend line, right? Even if we were to sweep this same local resistance point, if we're not technically breaking higher, we would still be showing bears in control to potentially be driving price down lower into this interest point we were just talking about of roughly 2550s to 2540s. And if we also just start to clear below these lows around 2620s, that's also just viable continuation of day trades and swing trades to be driving down into these previous lows in area of interest around 2550s. Now, I could be 100% wrong. But for me to validate I am wrong and to adapt accordingly, I would need to see more fundamental reasoning that would support gold bulls. Whether it is economic data results for important data that feeds rate cut bets, whether it is data that feeds rate cut bets and, of course, a shift of structure here, or any reactive events that actually induce a heavy amount of fear, uncertainty, and doubt, and really spark a lot more demand in gold due to its safe haven appeal starting to shine in that fear filled environment. We haven't really had those catalysts yet. Even with the slight declines in the S&P data we had today, gold didn't really see much upside. It just ended up ranging. So I'm not fully confident in the gold bulls just yet. I would prefer to play some of these bearish moves still. Bringing that information together on the intraday time frames, we can see into the weekly open, we've had quite a bit of indecision around 2625 to 2645. Now, just with simple order flow setups, if we can break above 2640, even 2647, I would love to see a sweep to retest bearish structure in the same resistance point, even creating more of a technical double top at this point before looking for better sell positioning. Very similar to what we are breaking down through the New York session. Otherwise, if we see dollar just starting to stabilize again, economic data results still pushing back rate cut expectations, like elevated services PMI data, which shows upside pressure of services inflation within the US economy. If we break below 2630, and especially if we clear these lows at 2623, that would signal to me that we're not really going to get that double top at the 2660s. We're just going to see continuation of bearish plays and bearish sells to at least on the minimum be driving down to fade out this bullish move, and on the minimum be coming into the 2600s, hopefully even into the 2590s there. As a day trader, potentially even positioning some swings, I'm going to be patiently waiting for these areas of interest. Of course, share my main bias and why I'm supporting that main bias, right? Dollar pairs. So on dollar pairs, as we were breaking down the US dollar, still very bullish on the dollar. Technically bullish, fundamentally bullish. Your macro interest rate differentials. Fed's adjusting in the December 2024 summary of economic projections for a slower and steadier approach to rate cuts. The US economy remaining far more resilient compared to a lot of its global competitors. US dollar still holding that world reserve currency positioning, still having beautiful technical structure of continued higher highs being printed. This means on pairs like GBPUSD and EURUSD, we're still having bearish structure being respected. A problem with a lot of new traders is that they'll see a bounce from a low and they'll think it's time for a reversal, but they won't have any fundamental supporting factors for that reversal. They end up just getting caught in a pullback trying to reverse from a low, which more times than not gets faded out, is really just rebalancing of flows, sellers positioning from better entry points as dollar domination continues to take over, right? When I'm looking at GBPUSD, you can see from pretty much October of 2024 to where we are now, we've maintained beautiful bearish market structure, having lower lows printed with secondary phases that are just pullbacks or accumulations, and continuing to drive price down to at least retest those same lows and potentially go lower. I still personally see Euro USD going to the parity point with dollar and going back to being one-to-one value with the US dollar. And I still see GU going to historical lows as well. On the intraday time frames, we can see we had new lows printed here in a bit of a pullback phase. In my opinion, whether we get just a short-lived pullback on dollar, we're still showing sellers in control on GU below 2.6, even if we dig a little bit higher around 2.75s. I'm still going to be primarily looking for these two areas on GU for sells. Similar idea on Euro USD. Now, what this means is we could see some pullbacks into those prices before we start to short again. If you feel comfortable playing the bullish moves into those pullbacks to scalp the momentum or even for a day trade, by all means. But I would think it's a lot more advantageous to wait for the pullback, narrow down some higher time frame price points of interest, and continue to play the macro trend, which would give you the most advantageous and rewarding day trades and even swing trade positioning. Now, the downside of this is it means you might not get a trade every single day, or not even a trade through an entire week. But I promise you, if there's no shift in the macro fundamentals, if there's no shift in the technical pricing and structure, once these trade points of interest get retested and you do get execution, once the trade plays out, it's going to cover a lot more than a week of missed trades. As if you are continuing to trade every single day on the week, you're also going to take losses, spend commission, continue to waste and exert energy and capital as well. It's not like you're going to have 100% wins, right? So being patient can be a lot more beneficial. Now, if we do not get these deeper pullbacks, if we technically just start to break below these previous lows, and clear the wick here, that would show me just continuation sells, which seems like lower reward, but you would still be targeting on the minimum of retesting these same lows, which is still almost pretty much right on 100 pips. Fantastic day trade to take advantage of. But I still want to primarily be waiting for GBP, USD, and Euro USD sells and USD CAD buys. If we see the pullbacks take place for the scalpers, you can scalp the pullback, but don't think it's some higher time frame reversal. Don't think it's going to be some generational shift for no reason. Don't get caught holding the pullback as the main trend starts to come back into play. Euro USD is the same idea, except the sell zones I'm looking at are around either key level 1.045 or around 1.052 or back below 1.034. But similar idea of ECB keeping interest rates much lower than the Fed's due to the European economy needing the support of some looser financial conditions. European economy not as resilient as the US economy. Technical structure still being bearish. USD CAD, more of the inverse here. But would love to see pullbacks to 1.418 key level, or even tomorrow, if we don't get the deeper pullback, if we create a technical double bottom and come back above key level with dollar price stabilizing, would also look for buys back above the key level just to maintain beautiful market structure of higher highs being printed in just these short-lived pullback phases. With the minimum expectations on the day trade positioning that we could at least retest into these same highs, which is more than 130 pips of price movement, very advantageous ranges to take advantage of. So I'm still very pro dollar for those fundamental and technical reasons stated, and not just looking at the US economy alone, comparing it to global economies, comparing the policy positioning of what the Feds are doing versus other central banks. Now, SPX and US30 are a bit tricky. We are seeing a pushback on rate cut expectations. We are seeing some more inflows in the dollar, a slight support on the volatility index, a decrease of global liquidity flows in risk assets. I am expecting that we're going to see a secondary phase of market structure on SPX, and we may be trapped in a consolidation until we have way more important fundamental events unfold. I think SPX is going to be trapped from about around 6,100 highs to about 5850 demand zone lows. I would see short-term buys up to the highs before high risk, high reward sells, and I would see buys from the demand zone lows. Keeping it very simple, expecting a secondary phase of market structure where it doesn't look like a pullback, it looks like a consolidation is being created. No major liquidity inflows, markets taking a bit of a breather to start the new year, rebalance of flow moves. I would see short term scalp buys to these same all time highs if we don't break any higher. High risk, high reward, big shorts, or just intraday shorts, but mainly playing a consolidation phase being created here on SPX. US30 looks similar, except the consolidation phase isn't really at the all time highs here. It looks like we're going to be creating a consolidation phase roughly from this demand zone low to about this resistance point. With this being the consolidation zone that we may remain subdued in through the entirety of this week, at least until NFP. I would be looking for bearish plays and rejections from around 43,500 and bullish plays from around 42,000. Especially if we don't have any major reactive events, no fear, uncertainty, or doubt, very normal subdued market conditions, regular outcomes for economic data. Looks like US30 and SPX are in secondary phase of market structure, which against the macro bullish trends are looking like consolidation phases, unfortunately. Now, hopefully that was a very educational, informative, and valuable webinar. We went through the economic calendar, some personal data predictions, market AI predictions, reactive events and headlines. Oh, you're right, GJ. I'm so sorry. I'm so sorry. I almost forgot about one of our favorites, GJ. Sorry about that. Good reminder. Thank you for the private message. GBPJPY. I'm still very bullish on GJ. Bank of England keeping interest rates much higher than the Bank of Japan. UK economy far more resilient compared to the Japanese economy. And of course, still having very beautiful bullish market structure where I think we're going to continue to fade out this downside move and have GJ go back into the 200s, but within this wave formation and channel formation here. So I think that we're going to continue to correct this downside move, is what I was talking about, but not in as aggressive or volatile fashion, in slow and steady fashion. This piece of price action here is looking very similar to this bullish run here. I think we're going to see something very similar back into the 200 prices and even printing a new intraday high going into the deeper 204s, playing this very beautiful technical bullish channel that reflects the fundamentals supporting more GJ upside. So we're very bullish on GJ fundamentally. Have to look out for currency interventions. We're very bullish on GJ technically. Let's look at some entry points that we could take advantage of. We can see through the intraday period, we had some more buy orders accumulated with this beautiful break in retest around 196.2. Would love to retest there and still see continued buys. If we continue to hold above 197.5 key level, where we were previously showing some slight rejections, but now starting to break above, this would also be a very beautiful buy entry area for day trade and even swing trade positioning buys. Now, this is still very beautiful ranges to play to at least retest into this last resistance point. Have to be mindful of the reactions at that resistance point, but I would anticipate we could break higher. But even holding above 197.5, that's 140 to 150 pips to even just retest into here. But I would anticipate we could see new highs being printed, seeing GJ going into the deeper 200s, in my opinion. I want to continue to ride GJ buys from these prices and hopefully after a short reaction, even look for breakout buys above the 198.5s as well. Like we were talking about with the Japanese yen breakdown in the trade room before the freeze was done. You guys can review those trade room research pieces. But anyways, everybody, I don't want to be yapping too long. People complain when the webinars are too long, that they don't have time to watch it. But when we are really focusing on the fundamentals, technicals, economic events, price action, creating high probability trade ideas, you can't talk about it in 2 minutes. It takes time to go through everything. But hopefully that was an educational, informational, and valuable webinar. If you guys have any questions, comments, concerns, issues, or problems, I'll give you guys a minute in the chat. Otherwise, I'm going to save and upload this. It'll be available on the website as soon as possible, as soon as my internet allows. I want to thank you guys for your time, and I'll patiently wait for any questions and give you guys a minute here. Love the energy. Oh, appreciate that, man. Thank you. We're gonna keep this energy, keep this high work ethic up through the entirety of 2025. Keep each other motivated, keep each other disciplined, learning focused, value focused. But I don't see any questions, comments, concerns, complaints, or anything. So I'm going to save and upload this. I'm still going to be up. I'm just going to get another meal in before I sleep. If I see any opportunities through Asian, I'll send some chart updates in the trade room. Otherwise, I'm going to see you guys Tuesday morning Eastern time zone around 9 to 9:30 a.m. Eastern. We got ISM services PMI and Jolt's job opening at 10. All right. Thank you guys.